The first thing we want is doing a market analysis of the swing levels on a higher time frame. The high time frame I like the most is the 1 hour or the 4-hour chart, which is exactly where we are right now. I wouldn't bother doing the high time frame analysis on the daily chart, but also not on the 15 minutes or 30 minutes. So the 1 hour and 4 hour are the perfect spot for the higher time frame analysis. And the analysis shouldn't be so complicated. We're mainly looking at how the market topped and where it bottomed. As seen here, these were the bottoms, also known as the swing lows, and these were the tops, also known as the swing highs. Now, it doesn't take a genius to see how each swing low was higher compared to the previous swing low. So we've had higher lows, and also each swing high is higher than the past swing high. So we've had higher highs. When we have swing higher highs coupled with swing higher lows, we have a high time frame uptrend on this 4-hour chart. Now we have the last leg to the upside that we can see on this 4-hour chart. If we simply just follow trend continuation, so having a similar pattern of higher highs with higher lows just like we've had before, that means that the market has a high probability of pulling back down in order to fill a potential support, demand, or just to form the swing low. So we have a conflicting trend, because overall on the longer time period, we would expect this market to go higher, but in the short term, we expect this market to go lower. But this lower price movement is there as a pullback, to later hopefully continue a high time frame uptrend. So knowing this theory, we can use this potential pullback for sell short setups, or just wait for the market to reverse back to the upside. But on this video, we will take every opportunity, no matter the result, so we can learn what works and what doesn't work. So let's zoom into the last leg to the upside. Now we do analysis in this internal price action. So we've had the high time frame leg to the upside, but this straight up move is actually broken down into multiple lower time frame higher highs with higher lows. That until the market aggressively pushes down with pretty large bearish candles. These candles breaking down the past internal low, and as the last movement, the market is trying to recover back up. If we carefully analyze these points, we see a lower low that has been formed. And on the highs, we have the maximum high we've had recently, and we don't know if we will form a higher high or a higher low, that on the upcoming price action. But since we've stopped forming higher lows, and we formed a lower low, that's actually a huge warning sign that we've probably reversed into a downtrend. Keep in mind that a break of the past low during an uptrend is a bearish trend shift, or a change of character to the bearish side. The theory says that after a major break, like a break from a trend shift, or from a break of structure, after these breaks, a pullback is expected in order to rebalance the swing points, and we actually have the pullback happening right now at these levels. If the market would have reversed into a downtrend, again, as the theory says, we would reverse back down from a resistance or a supply that's taken from the highs, because the market reverses its formations into now forming a lower high, and in order to form a lower high, the market has to not break above the past high. So it must not break above this level, else the downtrend would invalidate. But if invalidation doesn't happen, and the downtrend respects, we are likely to see this kind of price action where we break the past low once again. And as I said before, after a break we would wait for a pullback to the upside, and once again rejection to the upside which would break the past low, and so on. The resistance or supply you should know by now if you've been on my channel for some time. It's the last bullish candle before the last bearish impulse, and it's taken from the whole candle, including the wicks. This entire level is the supply, and it's exactly where the market is heading to, being very close to it. So we can open right now a sell short position from this supply or resistance, since we have a higher probability the trend has reversed. The placement of the stop loss should have some logic behind, it's not placed randomly. The common sense of market structure says that if we expect a lower high, then we simply don't want the swing high to break to the upside. The stop loss is being placed above the swing high, and the take profit also needs logic. On downtrends, we have formations of lower lows, so it makes sense for the take profit to be placed below the past low. This is how you maximize the risk-reward ratio with a high probability setup, by using market structure fundamentals. Nothing extremely complicated so far. And this pullback fills the supply, with the exact candle that fills it, also pushing back down near instantly, with another pullback to the upside, pullback that doesn't hold and breaks into a lower low, closing this trade on a win. Now, as I said that it breaks into a lower low, and a break of the past low during a downtrend is a bearish trend continuation, now called as a bearish break of structure. So now we finished with this price action, We've done the analysis and took opportunity of a setup. Now we need to wait for the market to form more candles, more price action from where we can react depending on what the market forms. However, the more likely scenario is bearish trend continuation, that seen on the charts is a market with swing levels of lower highs, being the pullback to the upside, followed with lower lows in order to hold bearish continuation. And that's actually what happened if we look at it. We've got the downwards impulse that gets followed with an upwards pullback, this pullback barely being able to move up, because it shortly gets faded down into bearish continuation. This continuation breaking the past low. So again, a bearish break of structure. Now when a bearish break of structure happens, the most likely upcoming price action should be a pullback to the upside. And this pullback, if we're to hold bearish continuation, it most likely rejects back down from a supply or resistance. So the same story once again. We try to identify the supply, which should be on the last swing high that we see, around here, and more specific, the level of the supply is the last bullish candle before the downwards impulse. And we do the exact same placement logic as the last supply, so the sell short on the bottom of the supply, with the stop loss right above the past high, since we're not expecting a higher high during a downtrend. And the take profit being below the past low, since we're expecting a lower low during a downtrend. And this is actually a really good risk-reward ratio setup. This one might be a lot of higher quality than the last one, but let's see. So far, we see the pullback. This pullback filled the supply and also opened the order. A small rejection right now, but it goes a little higher. And this should be it. Massive bearish pressure, closing on the take profit a few candles later. Now, after any significant price action movement, we do a quick structural analysis once again, especially from the move that just happened recently, where we got an upside pullback once again that formed the lower high and pushed down into breaking the last low into a lower low. So it has kept the structural price action of a downtrend, and since we don't have any sign that this market is bullish, we still hold a bearish bias with a similar price action of a pullback to the upside that gets faded down into breaking the previous low to form a bearish break of structure. And it looks like we do have the pullback to the upside happening right now, with bearish candles starting to form, eventually breaking the past low, exactly like we've been expecting, with the bearish break of structure right here. And the last move that we're able to see is a pullback to the upside. Pullback that should be here to fill a supply or resistance, just like it did before, so it can push down into continuing this bearish momentum. Now we can follow the market into breaking the past lows with a supply or resistance. And as you should know at this point, that supply is found at the previous upside pullback. This is the new pullback, but it's not ended yet, so we don't know if the market goes higher from here, invalidating this potential lower high into a higher high. Or if this holds the theory of the downtrend by forming the lower high that later gets followed with a lower low, so we don't take into consideration the newly formed pullback, but we look at the last one that we see that it actually worked. Here. Should be around here, this being a quite small supply level. So we plan the setup similar as we did on the last ones, with the same logic, sell short on the supply, stop loss above the supply, but more important, it should be above the last high. And the take profit below the past low, this has a high risk-reward ratio, so we need to be careful because a wick can stop us out quick. But it looks like it also worked out well, the market pulling back up into the supply, filling the supply and the order with a wick, and rejecting back down with the same candle, and the next candle pushing down very aggressively. It's quite hard to find this type of setup. Will not be found often. But when you do, it's important to know how to capitalize on it. And it did exactly like before. It broke the past low, having a bearish break of structure. So far we have 3 winning trades on this high time frame downside pullback. So once again, after a bearish break of structure, we find a pullback to the upside. The pullback should be ending with a lower high on a supply level, the supply being the last bullish candle before the downside impulse. But the thing here is that this supply is at the same level as the last one, and the last one already got mitigated. So the quality of this new supply is lower than the past ones. Usually I would avoid taking a setup like this, where there are 2 supply levels that hit each other from where the new supply is inside the last supply, both being on the same time frame. This could work only if we use time frame confluence, and we switch into a lower time frame and find there a low time frame supply from where we can sell short. But from here, it's riskier. So the stop loss above the supply, while also being above the last high, and the take profit below the last local low, still having a great risk-reward ratio. But this time it ends up in a loss. Finally, after 3 great wins, and even with a loss like this, because the highly positive risk-reward ratio of the previous setups, you would still end up in net positive by a lot even after this stop loss. But now we move on and do the structural analysis, because after every important move we analyze what the price action has done. So here we've had the upside pullback, and this time instead of forming a lower high just like it did before, and just like it's normal in a downtrend, this time we have the first higher high after a while. A higher high means that we broke the past high, and a break of the past high during a downtrend is a bullish market structure shift or a bullish change of character. Now what it looks to be happening is that we continue to move higher so far without any significant pullback to the downside, and actually a pretty ugly price action with many wicks. When you see this type of price action, it's best to ignore it and just look at the swing points the market has formed, because the most important factor is the trend. As long as we know the trend, we just wait for the market to rebalance and print a more clear price action. Here, for example, on the latest movements, we see downtrend formations of lower highs, followed by lower lows. So we've had a price action that was increasingly going higher and higher, up until these levels where now we're starting to fall down. So we need to question, what's the level where we can spot the reversal again into an uptrend, where the market turns bullish? The level from where the market usually bounces up to the upside during a high time frame uptrend are demand levels, because keep in mind that high time frame we are bullish ever since this structure shift, and now we're getting the pullback to the downside. So we need to identify a high quality demand. Here it was one, but is already invalidated. The one from below is too small, so it gives a high risk. The one from below might be the first one that's of higher quality. Remember that the demand is the last bearish candle before the upwards impulse. There is also another one below, slightly smaller, but still high quality. And there is also the last one from the swing low, this one being quite large. So now we have 3 potential demand levels from where the market can bounce. Now the question is, from which one will it happen? Just from the pullback, no matter which one we'll respect, the market has to fill the first demand eventually, so we can start from the first one. Now on the internal price action, we're having a downtrend, but this downtrend is there to fill a high time frame demand. And no matter if this demand respects or fails, we should still have some kind of pullback to the upside in order to fill an internal supply. That should happen if this first high time frame demand doesn't respect. So a good opportunity would be to look for buy long setups on the bounce and sell on the supply. This is a scalp setup, and we can do that on the lower time frames. Or another scenario would be for the market to break above the last internal high. So this would continue the high time frame uptrend. In this scenario, we have the first high time frame demand that confirmed it respected. So in this scenario, we could wait for another pullback to the downside where we identify a demand inside the lower time frames so we can follow this uptrend with a buy position. But until this happens, we should wait for more price action data. And especially we need to see first if this high time frame demand even fills. And we take decisions only after it does. So patience is very important. And yes, the demand got filled right here. We're also having the last candle that's looking like it is about to bounce to the upside. If this internal downtrend continues, the market will likely pull back into the first internal supply and push down into lower lows. This being the first scenario, so we switch into a lower time frame and we check there if we can find a good buying setup. Because if we can't find one, we will just wait and probably look for the second scenario. So basically we wait for the high to break before looking for another setup. This is the same price but on the 5-minute time frame, and we zoom in so we can analyze the price action. Structurally, we look at the highs and we see that they were constantly lower. And the lows as well, that's just a simple downtrend structure. But we see that later we get this really aggressive leg to the upside. This upwards movement breaking above the first highs, and even above the ones from the higher levels. And from that point we enter into an uptrend. This uptrend is very easily seen. On uptrends, it's demand levels that usually respect, just like we saw earlier. And here the first important demand of this internal uptrend should be around here, which is the last bearish candle before the market started to push higher. This is the first demand that we got after the internal trend has reversed from a downtrend, as we've seen a couple seconds earlier where we've had lower highs and lower lows, with that leg to the upside that reversed into an uptrend. And this is the first demand after the internal trend has confirmed a low time frame uptrend. So from a demand, we can position ourselves with a buy long position from this internal demand, having the stop loss placed below the internal low of the demand, this in case if we're looking for a scalp setup. But there is also another option. We need to zoom out and basically we place the stop loss below the high time frame demand. Now of course, if we do this, we will also target a much higher take profit level, This placement of the targets is more suitable for swing traders. But since we've done such deep analysis, we pretty much increased the quality of low time frame setups, because usually swing setups are higher quality than scalp setups, but you can bring them to be more equal if you're deeply analyzing the internal market structure, just like we've done in this video. And talking about the take profit, in this case could be right above the last high that we can see here, this brings a 2.8 ratio, which is very good. And we can also zoom out to see if it correlates with any structural level from the price action on the left, and the take profit, if you pay attention, is actually just situated at one of the past internal lower highs. There are multiple lower highs here, but since this level we've reversed into an uptrend on this 5-minute chart, so it's likely that we're going to have one or many of these past highs broken into higher highs. We target the first one since it gives a good enough risk-reward ratio, not too high, also not too low, and we can spot more opportunities as the price action goes on. Right now the volume and volatility have increased a lot, but the market looks to be heading to the downside. Here we filled the demand, actually moved pretty close to the stop loss, and then pushed into the take profit in just a couple minutes. This was actually a quick trade. So, now that we've finished with this setup, we come back into the initial time frame on the 4-hour chart. And the price action that we've seen inside the 5 minutes time frame, with that setup as well, is seen as this on the 4-hour chart. So what had happened is that the price filled the high time frame demand, and now it's starting to bounce to the upside. Remember what we've said a couple minutes earlier. If this bounce fails to break into an uptrend, then we will likely see a rejection from an internal supply, this potentially dragging the market even lower. So it just continued the internal downtrend of lower highs coupled with lower lows. So this supply has actually worked and respected, since from the touch of it, the market broke past the previous low into an internal bearish break of structure. Now again, after a break, we need to wait for a pullback first before taking any action. And from this pullback, we have two probable scenarios. In one of them, we continue the internal downtrend by breaking again past the previous low in repetition, which would eventually break below the first high time frame demand and enter into the second high time frame demand. And on the other possible scenario, we reverse by breaking past the previous high. In this scenario, the first high time frame demand validates, and we turn the market into a high time frame uptrend once again. Now, until any of these two scenarios happen, we have two options. We can just wait, do nothing, and react only when we see either a break of the low or a break of the high. Or we can use this potential pullback to the upside as another setup opportunity, similar to what we've done on the last trade. And let's actually try. So we switch back into the 5-minute chart. Here we have the last setup, and we see what happened next. It filled the supply from the 4-hour chart, and then it pushed below the past low, and now we're having this price action kind of consolidating, or moving down, but with a decreased bearish pressure compared to what we've had before. But still, the key word is that it's still a downtrend in here, since we're able to see repeated lower highs followed with lower lows constantly. To spot the leg to the upside, we first need to identify a reversal inside this 5-minute time frame. So we just wait for the first high to break to the upside. Here, if we look at the structural formations, we had these lower highs and lower lows inside, with an impulsive downside movement, but this gets rapidly faded to the upside with an upwards push, recovering the price. And not only that, but it also breaks past the last highs from this last internal highs. So as I said before, also applies here. A break of the high during a downtrend is a trend shift. And because this is on the internal price action, on the 5 minutes chart, this is an internal shift from a downtrend into an uptrend. Now we need to identify a demand on the last structural price action inside this level, because it's here where all the action really happened. And the demand, or support, is the last bearish candle before the market started to move to the upside. Being this candle right here, this is the internal demand, which is inside the first external demand from the 4-hour chart. And now we repeat the same logic of the take profit and stop loss placements. So buy long on the internal demand, stop loss below the recent low, which is also placed well because it's right below the demand as well. And for the take profit, we can target either the last internal high, or we can also target the previous highs from this internal downtrend. One is right here, and as we go on the previous highs, we would target a higher level for the take profit. But this might be too much, in my opinion. And if you just want to scalp a high-quality setup, we can just target the last high. Even if the market would go higher, we still get a decently high risk-reward ratio setup. There is also the option to swing trade, and in that case we change the stop loss below the high time frame demand, and we would target near the previous supply for the take profit level. This increases the risk-reward ratio while also maintaining the quality of the setup, since the stop loss is placed below a high time frame structure. First, we need to wait for this internal demand to fill. Then we see the reaction from where we can move into the next step. Here the demand fills, and we have a small bounce to the upside. Now what we want to do is coming back into the 4-hour chart, and we see the price action there while the setup is already opened. We quickly move to the upside, respecting that demand from the 5 minutes time frame, straight into the past supply, and even breaking above it. But the most important factor from this recent movement is that we finally broke the last high, being a bullish market structure shift, this turning the overall trend from a downtrend into an uptrend. And it's likely to see some kind of pullback, which fills the demand and pushes higher in order to now form higher highs and higher lows on this 4-hour chart. You can combine this strategy with the concepts learned from my private program, which you can find on the link in the description, where we have the only things that actually work and nothing more, easily explained so you can skip months or years of trial and error. Thank you for watching.